Hey everyone, thank you for checking out our live stream today. Our topic is 1031 Guide for Mom and Pop Rental Owners and How to Become a Millionaire Investor. We are very lucky to have our guest today, James Callejas from IPX 1031. He is the preeminent expert for 1031 here in the Bay Area. And without further ado, here's James Callejas.
Pocket tax-free. Everything above that, it's taxable, sadly. On a married couple, the limit is 500,000. And if you sell your property and the gains are 500,000 or less, you just keep that gain money tax-free. Now, anything above would be subject to capital gains tax. However, on the primary residence, and there's a couple of good things to remember on this. Number one, there are many primary residences out there that are mixed use, meaning they rent out rooms, have an ADU, live in a duplex where they rent out one unit and live in the other. On a mixed use property, they can take advantage of the 1031 exchange on the investment side and the primary residence on the primary side. Now, in many scenarios, it doesn't apply. It's just a primary residence, and the gain could be millions in certain places. In a scenario like that, what you could do, move out of the primary, rent the primary, then rent it for 1 to 2 years, selling it at that point, still getting the 250, 500, and 1031 exchanging everything else. So the primary doesn't qualify, but there are ways to use the 1031 code to your advantage to protect all of that equity. So the three properties that don't qualify, again, the primary residence, number one, we've talked about that. Number two, the second home. Second homes don't qualify for anything but paying taxes. So if you were to sell a second home, you're just going to pay capital gains tax. But there is a way to salvage this type of property as well. Rent it, Airbnb it. Doesn't have to be a full-time rental property. All you have to do is rent it out 14 days out of the year and not use it for personal use more than 14 days out of the year. And then magically after 2 years, it qualifies for 1031 exchange treatment. Otherwise, you just sell the second home and pay taxes. And finally, the flipper property, the third piece of real property that does not qualify for a 1031 exchange. The flipper is the person that buys the property, fixes the property, and sells the property. Sadly, properties held for resale purposes do not qualify for a 1031 exchange. So in a scenario like that, what you would do is you'd buy it, you fix it, and then you rent it. How long do you rent it? It's really up to your tax advisor. It's not a black and white kind of answer. It's more of a gray answer. And the aggressive CPA will say, rent it for a year and a day. After a year and a day, do the trade. And the conservative CPA will say, rent it for 2 years, then do the trade. What I say is if you're going to wait 2 years or longer, don't ask anybody, you're good. If you're going to do it less than 2 years, make sure your tax advisor is on board. So again, let's go back to the beginning. The 1031 exchange is only about investment property. The three properties that don't qualify are the primary residence, the second home, and the flipper. You need to sell this investment property and buy another piece of investment property in order to take advantage of the 1031 exchange. Now, the 1031 exchange is just an internal revenue code. And if you follow the guidelines between this code, selling and buying investment property, you'll be in a position to pay zero in capital gains tax. And I got to tell you, especially in California, because that's where I live, they really, really get you good when it comes to taxes. A lot of people come to me and say, you know what, James, I'm just going to bite the bullet. I'll pay the 15%. And I'm like, what are you talking about? 15%. Maybe that's what you pay the feds. It might be 20. It might be a combo of the two, but don't forget the state. Don't forget depreciation, recapture, and don't forget Obamacare and the contribution you have to give when you sell a piece of property with gains. And sadly, people don't see that until they actually sell, cash out, and pay taxes. So the average in California, I would say, would be anywhere between 30 to 35% on every dollar of gain. Outside of California, it really depends on what state you're in, because each state has usually a different tax rate. Some have zero, some have as high as 13.3%, which is what we have in the state of California at the highest bracket. So just cashing out and paying the piper sometimes just stings a little bit too much. But the beautiful thing is we have the 1031 exchange. And now you know what it is. It's all about investment property. So most properties that are not the three that I mentioned will qualify for the 1031 exchange. That includes all commercial property and residential property that's used for a business or investment purpose. So that's a lot of properties that qualify for a 1031 exchange. We know that if we sell one and buy one within certain timeframes, which I will review, you'll be in a position to pay zero in capital gains tax. But then people come up to me all the time and they say, okay, James, I'm just trying to figure it out. I know you sell and buy investment property. That's a 1031 exchange. But why do people do this thing? It's to not pay the tax, right? And I let them know that no, that's not the reason. If you don't want to pay the tax, you don't sell your property. People do 1031 exchanges for a number of different reasons. I got to tell you, I've been a landlord for the last 21 years, and I've learned that I hate being a landlord because I hate dealing with people, the tenants, the trash, the termites, the toilets, the taxes, all the terrible T's that you have as a landlord, as an investment property owner. They just, I mean, like, it's really a grueling ordeal in some scenarios. I mean, you'll find people out there that have had an ideal tenant, but more often than not, you're going to find scenarios where it's been horrible. They don't pay the rent, they ruin the property, they have people there that shouldn't be there. They break the lease all the time. And many things happen to your investment and you're not getting the return that you deserve. So for someone like that, somebody who's tired of being a landlord, I would do a 1031 exchange to get out of actively owning the investment property into something passive. Then there's a lot of people out there that say, I love this. I bought a condo, started living in it at first. Then I got married, moved out, rented out the condo, didn't sell it, and made a lot of money. And I really like being this property manager, but the condo is not enough for me. I want to buy a duplex. I want to buy a triplex. I want to buy more units, more doors. So you have the person that wants to diversify their real estate portfolio. Then you'll have the person that says, you know what, I'm tired of California, or I'm tired of Nevada, or I'm tired of whatever state you're in, and I just want to get out of the state, but I don't want to pay the taxes. So I want to 1031 exchange my investment property somewhere else, and I'm going to move out there as well, or somewhere else. And then you have the person that says, you know what, James, I don't like being a landlord, but I can live with it. My cash flow is okay, but I don't really need it. I've taken advantage of the depreciation, so it doesn't really matter. But what I really want to do is I want to buy my dream home. That's what I want to do, and I want to do it on an island. So how do you make that happen? And here's what I tell them. I go, look, the beauty of the 1031 exchange is you can actually make that happen. Sell the investment property, do the 1031 exchange, buy the dream home, Airbnb the dream home for a couple of years, then move into the dream home, then sell your primary residence, collect that $250,000, $500,000, and call it a day. There are many ways to make things happen, whether it's buying a dream home, a vacation home, a commercial property, multiple residential properties, a combination of the two, whether it's to get out of an area that's subject to rent control to get the best return on the investment. A lot of people have investment properties because that is going to be the way they make money. They're going to look for cash flow. They're going to look for appreciation. They're going to look for both. The reason why we do a 1031 exchange is to get a superior piece of investment property, and that can be defined differently by investors all throughout the country. The beautiful thing of the 1031 exchange, it's the only vehicle out there that you can make a ton of money on, sell it, and not have to pay taxes as long as we follow certain guidelines. So here's the example. We're in California. I'm currently in Walnut Creek, so the example will be a Walnut Creek example. Let's say I bought a single family home in 1983 and I bought it for $100,000 and I bought it in this community in Walnut Creek called Northgate. And today that same property is worth $2 million. And maybe I lived in it at one point, maybe I didn't, but it's been a rental for the last 10 years and I want to sell it and I want to do a 1031 exchange because that's almost all gain. And I don't want to lose $600,000 to $700,000 in taxes. So the way it would work is I would list the property for sale. Actually, let's step back. The way it would work is prior to doing the 1031 exchange, I would contact this guy named James Callejas and let him know that I'm looking to do a 1031 exchange to make sure that my property qualifies and what I need to do. And after talking to James for like 3 to 5 minutes, because he can determine it that quickly, whether it does or it doesn't qualify, I'm going to tell him my plan. Surprisingly enough, James will answer me and say, you need to plan what you are going to buy in advance. it's ideal to have a plan A, B, and C, and let me explain why. Because you will list the property for sale, eventually accept an offer, and open up escrow. At that point, you'll need to reach out to James to start the 1031 exchange. In other words, put the legal documents together for the account, create the 1031 exchange account, because you can't touch the money. So he needs to put the paperwork in place. So at the close of escrow, the money doesn't go into your hands. It goes into that 1031 exchange account. So if there's a loan on the property, it'll get paid off. The closing costs will get paid off, but the remainder of the proceeds will go into the 1031 exchange account. And from that close date, the clock starts ticking. You got 45 days, and they're calendar days, so every single day counts, to identify exactly what you're going to buy. And from day 45, you have an additional 135 days to close on what you identify. Now, as long as you use all the money and buy of equal or greater value to what you sell, you'll be in a position to pay zero in capital gains tax. And when I hear this, or when I deliver this message to the potential seller, quite often I hear them say, but what about my original investment money? Or I heard that I only have to reinvest the gains. Or I heard that I only have to use the equity that's in the 1031 exchange account. Okay, those are all wrong answers. If I'm looking to cash out, I'm going to look at what I first bought it for. Were there improvements? Was there depreciation taken? What's the difference between that and the net sales price? And I'll pay taxes. It's different for a 1031 exchange. And this might seem unfair, but it is what it is. In a 1031 exchange, your target price is going to be the gross sales price minus only closing cost. So if I sell for $2 million and the closing costs are $100,000, as an example, my target price is $1.9 million. Doesn't matter what my gain is. Doesn't matter what my equity position is. Doesn't matter what I put in for the original down payment. I want to buy something for 1.9 using all the cash to pay zero in capital gains tax. Now, I have many people argue saying that this is not fair. I agree with them, but nobody cares what I think. The IRS is what the IRS is. And they say that all the gain money and the original investment money is pooled together. So if you look to take out that original 50,000 you put in, that portion would be taxable. You could still do it. You could buy something for less value, but any money you keep, any amount you pay of less value or buy of less value, that portion would be taxable. So don't think that you can just use the cash. Don't think that you can take the original investment money out without a taxable consequence. Don't think that you can't replace the debt with either a new loan or new cash. You got to get to that target price to pay zero in capital gains tax. Sheila, you were about to say something.
Yeah, but for example, the 2 million, people can actually buy up to 3 properties, for example. So I want a small condo because I'm retiring, and then I can buy uh, which I will occupy later when I retire, right? Because it has to be a rental first. And then the rest of the money, I can buy smaller homes that maybe give me better cash flow than one
Yeah. And,
investment,
and
right?
and that's the beauty of the 1031 exchange. You could diversify your real estate portfolio, and in some of that diversification, it could include an eventual dream home. It could include an eventual vacation home. It could include a lot of different things. And that's why I think it's so important that the initial conversation with myself, I'll let you know what you can or can't do, so that you
Mhm.
don't list the property, close escrow, and say, okay, James, what do I do now? Well, you already made a mistake, because now you have 45 days to figure it out. You want to figure it out before the property goes on the
Before.
market, so that when the property goes on the market, you start to implement these ideas. But you can absolutely do that, Sheila. You could buy multiple properties in a 1031 exchange. Now, you were talking about identifying 3 properties. There are actually 3 rules to choose from when it comes to identification. And I think this is a great point that you bring up, because and this has happened in my career, that somebody would just say, here you go. And it's the entire MLS. I've identified. Okay, you can't do that. You're limited in the number of properties that you can identify. The first rule is called the 3 property rule, the one that you were mentioning, Sheila. And this rule says that you can identify up to 3 properties. It doesn't have to be 3. That's just the maximum of any value. So there's no limit. Each property could be $2 billion. It doesn't matter. You want to go higher than your target price, but there is no limit. So you have the 3 property rule, where you can identify up to 3 of any value. But what if you're that person that is selling for $2 million, and you say, you know what, I want to buy in Fort Worth, Texas, and I want to buy some properties in Buffalo, New York, and I want to buy some properties in Louisiana. You can do all of that in a 1031 exchange, but you're not using the 3-property rule. You're going to the second rule, the 200% rule. And here's how it works. Look at the sales price of what you're selling. It's $2 million in this example. 200% of $2 million is $4 million. This rule says you can identify as many properties as you want, but all of the properties that you identify combined cannot exceed that 200% cap. In this example, that would be $4 million. So you could identify 10 $400,000 properties if you wanted to. You don't have to close on all of them. You want to close on at least 5 to get to 2 million. Don't have to do that either. But if you don't, you'll pay tax on the difference. So to me, it's, what are you looking to do? You looking to buy the one big property? Well, then it's probably the 3-property rule. Or you're looking to buy a bunch of properties throughout the United States, you're going to be using the 200% rule, because the 3-property rule is not going to take you very far. And then there's the final rule, and this one's the gambler's rule. So if you're a gambler, then you're going to really love this rule, because here's how it works. You can identify as many properties as you want. No limit on the value. And that's where people get excited. They're like, why don't we all use that rule? Here's the catch. You have to close on 95% of the market value of what you identify, all of them. And if you don't, your entire exchange fails. So basically that means if you don't close on everything, you're cooked. You're paying taxes. So I will not let you use that rule unless you consult with me. In my 26-year career that I've been a part of over 56,000 exchanges, I've seen that rule utilized after day 45 about 9 times. It doesn't get used that often. If you need it, I'll let you know. Now, you have to identify like-kind property. You're going to hear that term a lot. Now, here's what like-kind means. 3 questions need to be answered. Is it real property? Is it in the United States? Is it used for a business or investment purpose? If you can say yes to all 3, it qualifies. Here's the beauty. I could sell bare land that I cannot depreciate, because you can only depreciate a structure. This bare land probably doesn't get you cash flow either, unless like it's, I don't know, a pumpkin tree lot or a Christmas tree lot or some other kind of use.
Llama farm.
Right? Or alpaca, whatever it is. We're not even that, right? Because if it's just straight bare land, like a lot somewhere, you're not doing that. So in scenarios like that, you can't really take advantage of it, but you probably made a lot of money on it in terms of appreciation if that land is in the right area. You could sell bare land and go buy a condo that you rent, a townhouse that you rent, a single family home that you rent, a duplex, a triplex, a 20-unit building, an office building, a warehouse, a retail shopping mall. So what like-kind means is I'm selling any real property used for a business or investment to any real property used for a business or investment. It doesn't matter if it's residential or commercial. It matters if it is used for a business or investment purpose in the United States and even some U.S. territories. If I wanted to go to Guam, I could do Guam. If I wanted to go to the Virgin Islands, the U.S. Virgin Islands, I could go to the U.S. Virgin Islands. If I wanted to go to America Samoa, the Northern Mariana Islands, not Puerto Rico. For whatever reason, actually, I know the reason, but not Puerto Rico. It doesn't qualify. There's provisions within the statute of being a sovereign state that does not allow it to comply with Section Code 1031, but the other ones do. And we've had, I've done Guam ones and U.S. Virgin Island ones. I haven't done America Samoa or the Northern Mariana Islands. But if you're going to go in that direction, let me know. There's things you need to do first, but it's not too difficult. So the idea is, go ahead.
There's just one point I wanted everybody to know. So we're starting to talk about properties outside of California. So for those who are thinking of doing an exchange outside California, you really don't need other 1031 intermediaries to get it done. You only need James, and they will take care of all the rest outside of California, if I'm not mistaken.
No, that's a great point. I'm a national rep.
Mhm.
I reside in Northern California, but I've done exchanges in almost every state. I haven't done Alaska, but I have done, our company has, but I have done a 1031 exchange for my clientele in every single state outside of Alaska and some U.S. territories as well. Very happy to help you in any state. East Coast is usually attorney driven. West Coast is escrow driven. Midwest is a combo of the two, but it doesn't really matter. All you need to know is contact me in advance so I can make sure that it qualifies, go over the rules and your plans, and then you just implement and you identify properly. you identify like kind property, and you close on it within that time frame. People, I talk to people all the time. They're like, is it really that easy? Yes, it really is that easy. And I tell them the hardest part, it's not what I do. I can answer questions all day long. The hardest part is for you planning out what you're going to do and then getting the right team around you. And I think Sheila could really help you with that, to sell and buy the real estate. You don't just go into something like this where you have a unique, unprecedented opportunity to build wealth within your portfolio without paying taxes, without having the right team in play. It just makes no sense whatsoever.
Correct. So to be able to do all these things, you actually need partners like your chosen realtor. You also need a lender to make sure you are qualified for all the purchases that you are planning. And obviously, we need the title company to make sure that nothing falls apart while James is trying to do their thing, right? So yes, this is a great opportunity, but make sure you have your team in place as well, plus the planned purchases, kind of all planned out beforehand before you get started. There is one thing also that, James, can you explain the DDD, like defer, and
Yes. Yeah.
that? Yeah,
So a couple of things. I wanted to piggyback on what Sheila was talking about. I also would like you to have your own tax advisor and
correct.
perhaps
Yeah.
a real estate attorney. Um, no, you don't have to call a real estate attorney right when you are doing this, but you just want to have one that you can rely on as an investor in that scenario. If you need somebody that you can call in a jam like that, I could always refer. I'm sure Sheila can as well. You just want to have, it's the same thing, right? Like, just, you have a painter that you call, you have a handy person you call, you have a plumber that you call, you have an inspector that you call, you have just all these people just in case. So I think that that's really important. You know, people sometimes come to me and they say, well, I don't get it. Like, so I just don't pay taxes now, but you said defer, not pay. And what's the end game here? What's the final strategy? Because am I just prolonging the inevitable of paying taxes? And you know, it's a very good question, because a lot of people out there may eventually cash out and pay the piper. And they may strategically do that. They may have moved into a different state, may have different tax rates, they may have made less money a certain year that they look to cash out. But the big question is, what is the end game? Now, to me, I follow the 1031 motto. It's buy till you die. Because in real estate, when you die, the basis is stepped up to current value, and the beneficiary could sell the asset at that point and not realize any gain. Let me explain what that means. So, original cost basis, and this is how you determine gain, is the original purchase price. So, if I bought something for
Like the
200,
Walnut Creek one.
like the Walnut Creek one, if I bought it for $200,000, and the basis can change because I could put money into it. Let's say I put $100,000 worth of improvements. That 200 number is now 300. And if I took depreciation, that'll lower the number. So if I depreciated 50,000, now my basis changes to 150,000. And if I sell for 2 million, I have to pay taxes on $1,850,000. Huge gains. Huge gains. But get this, if I were to pass away, and this is my property, that $150,000 basis is what they call stepped up to current value. So that 150 now becomes 2 million. My beneficiary will come in, inherit the property, then sell it with the basis of 2 million and sell it for 2 million. There is no gain. They don't pay capital gains tax. So to continuously defer and die is most of our investors' strategy, because what they're doing is they're building up equity, right? And you could always refi and take money out. That's not taxable. And they're getting better investment properties for better cash flow and better reasons. But eventually, they're estate planning for their family, either for the surviving spouse or for children, or if they have nobody, they could always name James as their beneficiary. And I'm more than happy to
Or
come in
Sheila.
and or Sheila or both, right? And help them spend that money that they so rightfully earned over the years. So it's a very good point. Sheila, what is the end game? And for some people, it's cashing out. For some people, it's moving into the property. For some people, it's just they never stop exchanging to better properties, and they'll do it till they pass.
All right. Now, a lot of our audience actually would be what I would call our mom and pop investor, wherein they grew up being taught that um, buy property, buy rentals, and that's how you grow wealth. But you mentioned something earlier about the vacation home and how would somebody, for example, a single homeowner, maybe take advantage of 1031 exchange to buy themselves a vacation home, maybe in Hawaii or Tahoe, which is very popular destination area for Californians like us.
Both of them are very popular, or Napa or Sonoma, or there are many different areas as long as it's in the United States that will qualify. And, a lot of our clients don't need the cash flow, but what they don't want to do is pay the taxes. And what they do want to do is either buy that Tahoe or Hawaii property or what have you type of property. And this is a very popular strategy. And it's, again, in advance, I always recommend, where do you want to go? Oh, you don't like people at all? Well, then I would recommend Lanai in Hawaii. There's only about 3,700 people that live on that island. So I would look and see what inventory is available out there, or if you like a little bit more people, go to Kauai or go to the Big Island in some of the areas. I mean, there are many ways to look at what you're going to do in advance. And when you've kind of selected what the plan is, then you will look to sell your property. Because if we're talking Bay Area property, I mean, you could put it on the market tomorrow, and as long as there's really not anything majorly wrong with it, you're probably going to sell it in most areas. And the problem again is the 45-day window. So if I'm looking for a vacation home, a primary residence, I don't want to just buy like an investment property, right? For an investment property, it's more about the numbers. For a vacation home, it's more about, yeah, this is it. It's got 4 bedrooms, 3.5 bath. It's 2,700 square foot home on a 10,000 square foot lot overlooking the golf course or the beach or what have you. In scenarios like that, you want to look in advance and see how much inventory is available, because you might struggle to find something like that. But it can be done as simple as listing your property for sale, buying that vacation home. For the first 2 years, I would Airbnb it. You can use it not more than 14 days. You can use it when you're working on the property, but for the first 2 years, you want to rent it a minimum of 14 days and not use it more than 14 days. And after 2 years, you could convert it to a full-time vacation home. And when I hear people looking to do this, some of them say, you know what? Look, I'm looking to buy a primary residence in Alamo, California, and there is nothing available for what I want in there. There's rarely anything available, period. So 45 days is not going to cut it. Is there any other strategy? And then I would recommend the reverse exchange. And they go, ooh, what's that? And the reverse exchange is where you buy Alamo first and sell the relinquished property second. And people say, well, how does that work? Well, you would be buying first and you'd have 180 days to sell your property. And when they hear that, they're like, well, let's do that. Well, hold on. It's not that easy for everyone, because in a reverse exchange, you're buying first and you don't have the money from the sale property yet. So how are you going to do this? Some people, believe it or not, have the $3 million in cash where they could buy the property. And that's where the reverse exchange is very easy. The way it works is they get in contract to Alamo, they open up escrow, they call me up and say, we're ready. Send me the contract, send me the prelim so we can set things up. I'll send you an open order form. You'll fill it out and we'll get things in place. And in a reverse exchange, and this is where it's different from a regular exchange, we as the exchange company will set up an LLC that will go on title to the property at the close, because the client can't be on title to both properties at the same time. From that close date, they will have 180 days to sell their property. So they bought Alamo with all cash, $3 million. They sell Northgate in Walnut Creek. We'll just use that as the example for $2 million. It's free and clear in this example. They get the $2 million, they put it back in their pocket, and now they have Alamo and they completed the reverse 1031 exchange. Easy peasy. Again, the hard part of that was, who has $3 million? Not many people. So if they can't come up with the cash, then they have to get financing. when there is financing in a reverse exchange, it becomes more challenging because if you are looking to get conventional financing on a residential piece of real estate and there is an LLC going on title, the conventional lender does not lend to this, you will probably have to go private money. Private money will probably charge 2 to 3 points. So the fees for a reverse exchange, number one, are higher than a regular exchange. And number two, if you're getting financing, now you're going to have to deal with the lender fees. So it's a lot more in cost, but it gets you the dream home. And a lot of people say, well, you know what? My capital gains tax, I was going to be paying about $500,000, whatever the number is. The reverse exchange at the end of the day, because I have to get a loan, may cost me 10 to 20. Still way worth it. And I get the dream home that I want and I protect all of that equity. And then there's the person that just doesn't have the cash and can't get the financing. We don't bring the reverse exchange up to them because it won't work for them. But in a scenario like that, Sheila, and I think this goes back to the vacation home primary residence, sometimes reverse exchange is the safest way to get the actual dream home. Now, sometimes people are buying new construction. I can get in contract today for a property that's not going to be completed until next year. And I'll strategically not list my property for sale until I know that the property I'm buying is going to be completed within that 6-month time frame. So there are ways to secure properties in advance outside of the reverse exchange, and that's usually for new construction, unless the seller is willing to go contingent upon your sale.
I have one last question because we're over time, but nowadays it's actually common to have an ADU, right? It's the
Right.
thing.
It
And
is.
they would have their ADU maybe rented out. And how does that perform in an now in
So
an
if I have a primary residence and an ADU on the property, it's a mixed use property. And on my tax returns, there will be a percentage of the property that will be for the ADU and a percentage for the primary. Let's call it 80-20 in this example. When you sell the property, the 250,500, if I've lived in it 2 out of the last 5 years, will protect the 80%. And then the 20% will be eligible for a 1031 exchange. So you could do that as an exchange and get the 250,500 and combine them in the same transaction. So there are ways to put things together. Again, when we have the initial conversation, you tell me what you want to do, you tell me what you have, and I'll give you options. I don't care what you do. I care that you get the right information. And if you need my help, I'd love to help.
Well, with that, we'll conclude our discussion for right now. Uh, because 1031 is such a big topic, actually, we'll have James again come by and do another round, maybe answer different sets of questions regarding 1031 later on. And stay tuned for our schedule of live streams. We'll, of course, post it on social media. With that, we say good night. And we'll see James again till our next live stream.
Thank you so much for having me, Sheila. Good night, folks.
Thank you, James.
You're welcome. Bye bye.
Bye.